You know that feeling when you check your bank account after payday and somehow you're still broke? Meanwhile, Elon Musk literally paid $0 in federal income taxes in 2018. Zero. The guy who was worth over $20 billion at the time. And here's the kicker, it's completely legal. In fact, it's not even a loophole. It's just how the system is designed to work. But only if you know the game. Look, I'm about to show you why working harder and making more money might actually be making you poorer. And no, this isn't some clickbait nonsense. This is about understanding the single biggest wealth-building strategy that the ultra-rich use every single day, and why your financial advisor probably never told you about it. I'm Alex, and on this channel we talk about money, personal finance, and the economy in ways that actually make sense. And today, we need to talk about something that could completely change how you think about wealth, taxes, and why you feel like you're working so hard, but getting nowhere. This is the buy, borrow, die strategy. And it's the reason billionaires can buy yachts without selling a single share of stock while you're over here getting taxed on your overtime. So make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's the thing. Most of us have been taught that wealth comes from income, right? You go to school, get a good job, work your way up, maybe hit six figures if you're lucky. That's the dream. That's success. Except it's not. At least not for the truly wealthy. Let me paint you a picture. You're making $100,000 a year. Great salary, right? You're in the top 20% of earners in America. But here's what actually happens to that money. Federal taxes take about $18,000. State taxes, depending on where you live, maybe another $5,000. Social Security and Medicare, that's $7,650. We haven't even talked about property taxes, sales taxes, or anything else. You're left with roughly $69,000 after taxes. Now subtract your rent or mortgage, car payment, insurance, groceries, student loans. And you're wondering why you can't seem to get ahead despite making what everyone told you was good money. Now you might be thinking, well, yeah, that's just how it works. Everyone pays taxes. Wrong. Not everyone. And that's the part that should make you angry. Here's what most people don't realize. The richest people in the world take almost nothing in salary. I'm talking about the CEOs running trillion-dollar companies. Jeff Bezos, his Amazon salary was $81,840 a year. Mark Zuckerberg, $1. Yeah, you heard that right, $1. Elon Musk took zero salary from Tesla for years. Larry Ellison at Oracle, $1. Larry Page and Sergey Brin at Diebel, $1 each. Now, obviously, these guys aren't surviving on $1 a year, so what's going on? They're paid in equity, stock, ownership in the companies they run. And this is where the entire game changes, because here's the beautiful part. Stock that goes up in value doesn't get taxed. Not until you sell it. Let's say you bought a house for $200,000. 10 years later, it's worth $500,000. Did the IRS send you a tax bill for that $300,000 gain? No, because you didn't sell it. The gain is unrealized, that only exists on paper. You only pay taxes when you realize that gain by selling. This is called the realization principle, and it's the foundation of how the ultra-wealthy avoid taxes. They accumulate assets that appreciate in value, and they simply never sell them. But here's where your brain should be screaming a question at me right now. If they never sell anything, how do they actually spend money? Like, how does Elon buy another mansion? How does Bezos fund his space company? This is where it gets really interesting. They walk into a bank and ask for millions of dollars, and the bank says yes, immediately, at interest rates you and I could only dream of. See, when you and I need to borrow money, we're considered high risk. You want a $30,000 car loan, the bank's going to charge you 7, maybe 9%. You want a mortgage? That's 7% right now, maybe higher. Credit card debt? We're talking 18 to 25%. And you know what you're paying that with? After-tax money. Let's do the math on this, because it's actually insane. Say you've got a $2,000 monthly mortgage payment. That's $24,000 a year. But to have $24,000 after taxes to make those payments, you need to earn roughly $37,000 before taxes, assuming you're in a 35% tax bracket. So you're paying income tax first, then you're paying interest to the bank. You're getting hit twice. The system is designed to extract maximum value from your labor. But the wealthy, completely different game. Let's say you own $100 million in Amazon stock. You walk into Goldman Sachs or JP Morgan, not your local bank branch, but the private wealth management division. And you say, I need some liquidity, but I don't want to sell my shares. The banker doesn't even blink. They say, no problem. We can set up a securities-backed line of credit. They'll lend you 50 to 70% of the value of your holdings. So on $100 million in stock, you can borrow $50 to $70 million. And here's the kicker, the interest rate, maybe 2 to 4%, sometimes less. You just borrowed $50 million at 2.5% interest. Your annual interest payment is $1.25 million. Meanwhile, your $100 million in stock is still sitting there, growing. If the market goes up 10% that year, you just made $10 million in unrealized gains. You borrowed $50 million, paid $1.25 million in interest, and your net worth went up by $8.75 million. No capital gains tax, no income tax, just pure wealth accumulation. And this is the part that breaks people's brains when they first hear it. That borrowed money, not taxable. Loans aren't income. You can spend that $50 million on whatever you want, and the IRS doesn't care because technically you have to pay it back. Except, here's the secret. You never really pay it back. Look, your assets keep growing, right? So in 5 years, that $100 million in stock is now worth $150 million. You go back to the bank and say, hey, I'd like to restructure my loan. They look at your new net worth and say, oh, absolutely, we can extend your credit line. How does $80 million sound? You take that $80 million, pay off the original $50 million loan, and you've got $30 million in fresh cash to spend. Still no taxes. You just keep rolling the debt forward, refinancing as your assets appreciate. The bank is thrilled because you're a constant source of income for them. Even at 2.5%, they're making millions off you in interest, plus they get all your other business, estate planning, trust management, investment services. You're living off borrowed money, your assets are growing tax-free, and you're paying less in interest than most people pay in credit card fees. Now you might be thinking, okay, but eventually you have to sell something, right? You eventually have to pay back the loan. This is where the strategy gets its name. Buy, borrow, die. Because eventually you do die. And when you do, something magical happens in the tax code. It's called the step up in basis. And it's probably the most valuable tax benefit in the entire American system. Here's how it works. Say your grandfather bought $100 million worth of Apple stock in 1995. Today, that stock is worth $50 million. If he sold it while alive, he'd owe capital gains tax on the $49 million in profit, roughly $10 million to the IRS. But he doesn't sell it. He holds it until he dies.
When he passes away and you inherit that stock, the cost basis resets to the current market value, meaning as far as the IRS is concerned, you bought that stock for $50 million. If you sell it the next day for $50 million, you owe zero in capital gains tax. The $49 million in gains, you're erased. The tax liability, gone. And what about all those loans he took out over the years? Well, wealthy people plan for this too. They take out massive life insurance policies, often $100 million or more, held in irrevocable trusts. When they die, the insurance pays off the loans. The heirs get the assets free and clear, with a stepped-up basis, owing nothing. The wealth transferred to the next generation, completely tax-free. And the next generation can start the whole process over again. Buy appreciating assets, borrow against them, die and pass them on tax-free. Look, this isn't a conspiracy. This is just how the tax code works. It was designed this way intentionally because the people writing the laws are either wealthy themselves or funded by wealthy people who benefit from this system. And here's what frustrates me. Most people will never hear about this. Your high school economics teacher didn't teach you this. Your college professor probably didn't mention it. Even your financial advisor might not explain it because they're focused on managing your 401k, not building generational wealth structures. Meanwhile, you're out here grinding 50, 60 hours a week, getting taxed on every dollar you earn, paying interest on every dollar you borrow, and wondering why you feel like you're running on a hamster wheel. The system is designed to extract wealth from labor and protect wealth from capital. Now, I know what you're thinking. Great, Alex. Super depressing. I don't have $100 million in stock to borrow against. What am I supposed to do with this information? Here's the thing. You might not be able to use this strategy at scale yet, but you can understand the principles and start applying them at your level. 1. Stop thinking of income as the goal. Start thinking of asset ownership. Every dollar you can put towards owning something that appreciates, stocks, real estate, even a side business, is a dollar that can grow without being taxed until you sell. 2. Understand that debt isn't always bad. Good debt is debt secured by appreciating assets at low interest rates. Bad debt is consumer debt on depreciating assets at high interest rates. 3. If you ever do build significant assets, talk to a real financial advisor, not just someone selling you mutual funds, but someone who understands tax strategy, estate planning, and wealth structures. And 4, get angry enough at this system to either learn how to use it or vote for people who want to change it. But whatever you do, stop playing the game by rules that were designed to keep you broke. The ultra-wealthy didn't get rich by working harder than you. They got rich by understanding that the system rewards ownership, not labor. They buy assets, borrow against them, and pass them on. And they do it all while paying less in taxes than you probably paid last year. That's the game. Now you know it exists. If this opened your eyes, hit that subscribe button, because we're going to keep breaking down exactly how money really works in this country. Drop a comment. Let me know. Did you know about the buy, borrow, die strategy before this video? I'm Alex, and I'll see you in the next one.